FCMB is the latest bank to report its Q3 numbers. Some strong growth there in the bottom line, 72% growth. For Q3, gross earnings up 23%. So bottom line growing a lot stronger than what we saw on the top line. But overall, just give us your impression of the numbers from FCMB.
Okay, Samantha. Well, the 9-month figures continue to show good year-on-year momentum, consistent with the sector as a whole. Although we do also notice that for many of the names in our coverage universe, the Q3 numbers showed some softening of the momentum versus, what banks delivered in the first half. And FCMB wasn't really an exception there. But overall, we are still happy with the general direction of things. Their full-year annualized ROE figures at 7.7% are relatively soft versus some of their peers. Access Bank is looking more like sort of nearer 10% and Skybank looking nearer 13%, for instance. But we haven't factored in any kind of impact of the acquisition on their numbers at present. Nevertheless, it's a significant improvement on 4.5% ROE delivered in 2010.
The stock has been heavily discounted, down some 50% for 2011, sitting at 4 Naira. Would you be getting in at this level or still waiting to see how that merger pans out?
To be honest, the whole of the Nigerian banking sector has sold off significantly. FCMB, like its tier 2 peers, is trading at around 0.5 times 2011 book. If we look at the ROE outlook for the bank for 2011, I think well below 10% is not, anything to be getting crazy about as far as we're concerned. And it's, one must look at these things on a relative basis. If Skybank can deliver 13% and its price to book is 0.5 times, then it kind of makes FCMB a little bit less compelling, in the immediate. However, over the medium term, with the consummation of its transaction with FinBank, we ought to see, for instance, a far stronger funding platform for the bank, which ought to help to improve NIMs and allow it to compete more effectively in some of the segments in which it is focused. So in the medium term, I think that they ought to be able to position themselves well in an increasingly competitive market with that transaction. But the valuations right now, based on the immediate visible performance, it's hard to argue that it is particularly compelling over and above its tier 2 peers, whilst the whole market looks relatively cheap. So
it all depends on really your investment horizon. Let's look at what the tighter interest rate environment means for banks, especially in the tier 1 space. How are we likely to see the likes of First Bank being affected versus Zenith and GT Bank?
Well, as far as the current environment is concerned, with respect to rising rates, our position is that we are strongly in favour of the tier 1 banks at this point, and particularly First Zenith and GT, less so with UBA. The reason being that these guys have a naturally cheap funding platform. We think they'll be able to sustain cost of funds of between 2 and 3.5% through the cycle, whereas some of the second-tier banks will struggle. We think that the tier 1 banks have a sort of a 150 to 250 basis point advantage with respect to cost of funds. So, the likes of Skybank, for instance, Access, will expect their cost of funding to creep up towards the sort of 4.5%, 5%, before taking account of any M&A. Diamond Bank is something of an exception here, but I think that that's only sustainable in a relatively moderate loan growth environment. First half cost of funds was 2%. But loan growth is still not particularly aggressive across the board. And with rates rising as aggressively as they are, we think that they will not be able to acquire retail deposits at the rate necessary to keep funding as low as that. So they will also experience some pressure, albeit less than some of their tier 2 peers.
Another pressure point potentially is the impact of the weakening Naira. Now, if you look at banks that are most exposed to dollar-denominated loans, GT Bank sitting at the top of that list, so too is First Bank. But you see the weakening Naira as potentially benefiting banks overall. Just run us through your thought process on this.
Okay, well, on the whole, GT clearly has the most, in terms of volume of dollar-denominated borrowings with its Eurobond. The first Eurobond matures in 2012, January, and of course they've just raised another 500 million. So they have interest to be paid on almost $900 million of debt. First Bank has significantly less, at about 175 in terms of Eurobond volumes. The point really here is that most of the funding for Nigerian banks, the US dollar denominated funding, does not actually come from borrowing. It comes from domiciliary deposits, most of which are at very low to negligible interest rates. Now, the point is that if these banks have lent these funds to counterparties that have dollar income flows, then they have, a natural hedge, and the translation effect when they translate these dollars back into naira, should be overall positive on their interest income line. As far as interest expense is concerned, yes, for GT, they have the largest volume, but they also have a significant amount of DOM deposits. So overall, we think they're relatively well hedged. And for the rest of the universe, frankly, DOM deposits dominate. So if we assume that there is no deterioration in asset quality, which is a broad assumption, admittedly, but we even looked at it even if banks had to put half of their dollar loans back into naira, we still saw that the ROE impact for 2011 is really just a matter of basis points. It's not a significant impact, even if the naira goes to 200. Yeah. So we are not concerned about the impact of a devaluation for the moment on Nigerian banks. Obviously, if there were asset quality issues, that would be a different story. Yeah. But based on the information we have, we are not concerned right now.
But worst case scenario, naira 200, and not a problem at this point in time. Rele, thanks for your insights and time this morning. Rele Adesina, Head of Research at Stanbic IBTC Bank.